Hi, my name is Tom Dorsey. My company is Dorsey, Wright & Associates, and it's a pleasure to be out here in Burbank at Futures West. What we're going to cover today is a course on point and figure technical analysis, and I'm going to go through the course from A to Z, exactly how to trade commodities with point and figures. A little about my company. We're from Richmond, Virginia, and we are primarily involved with the equity markets. We advise probably over 120 broker-dealers throughout the country, and in most cases act as the firm's outsourced research technical analysis department. We also advise numerous money managers throughout the world, from the George Soros Quantum Fund to Morgan Stanley's trading floor, numerous money managers. And we also trade our own proprietary commodity account. Susan is here with me. She is our commodities trader. She runs our hedge funds also. It's primarily for our own corporate money and some partners that we have involved with us. We also have a money management company in Pasadena, California that's primarily involved in individual equity money management. We'll be opening up our commodity money management relatively soon, but right now we don't have that available. I'm probably one of the only speakers here this weekend that has absolutely nothing to sell to you. My company does not provide any commodity research for anyone. We don't provide any commodity charts for anyone. The reason I am here is one single reason, and that's to impart to you my knowledge on trading commodities on point and figures, and nothing more. That's as far as it goes. There is a book that I have written primarily on the equity markets on point and figure trading, with one chapter involved in commodities, but it's primarily involved with equities. We're here to talk about futures today. One of the things about the point and figure method is the antiquity of it all. There's nothing new about this, and nothing new that I have created in this whatsoever. The point and figure method is over 100 years old and came directly from Charles Dow, who was the first person to begin recording stock prices in the United States. He was also the first editor of the Wall Street Journal. And Charles Dow, what he used to do is, he was primarily a fundamental analyst, but he found a need to understand the supply and demand relationships of the stocks that he was trading, or the commodities that he was trading. And he had a very unique way of recording this, this basic supply and demand. And he never really set out to create a new method of technical analysis. He was simply doing this for his own edification. It wasn't until the early 1900s that some very astute money managers happened to notice that many of the chart patterns Charles Dow recorded had a tendency to repeat themselves. Now, what you're about to learn today is a lost art. This started over 100 years ago, as I mentioned, with Charles Dow. This has been a lost art basically since the 1960s. For some reason, I think maybe with the advent of computers, people are looking for the easy way out, to punch the computer button that'll give them the exact answer, or the more high-tech way of looking at things. And they miss the basic fundamentals of what causes stock prices to move. And I found it interesting this weekend, coming out here on the plane in the new Worth magazine, they had a section on technical analysis, a primer. And the whole section was involved in technical analysis of stocks and commodities and things of that nature. And it had one paragraph on point and figures, and let me read it to you. The third type of chart is the point and figure chart. It records a price only when the price fluctuates by a predetermined amount, usually 1 point or more. Upward moves are plotted by using the letter X, while downward movements are denoted by the letter 0. This is a good way to track price momentum. But since point and figure charts disregard time and volume and are difficult to interpret, professionals recommend that amateur investors focus on line and bar charts. Here's an article going out to numerous investors throughout the United States, basically telling them that point and figure charts are basically too difficult to understand. Forget the point and figure chart, let's look at the line and bar charts. When that couldn't be further from the truth. The exact opposite is what's true. The point and figure chart is simple, logical, and straightforward, and basically leaves no room for subjectivity. Where the other methodologies, the bar charts and the line charts, are so difficult to read because they take into consideration so much data. You're a rare group of people to come in here today and learn this methodology, because really there's nothing high-tech about it. In the 1900s, well, what Charles Dow used to do, in fact, I'm going to show you the chart in just a moment, but what he used to do, the way he recorded this chart, is think of a piece of chart paper for a minute. And before I show you this chart, I want you to visualize this. Look at a piece of chart paper with the boxes in it. What Charles Dow would do is just simply take a point on that chart paper, just any point, you could throw a dart, and let's say XYZ commodity was moving from 30 to 40. and we'll just pick the numbers out of the air. He would simply go to a box on that chart paper and begin writing the price 30 to 40 straight up. 30, 31, 32, 33, 34, 35, 39, 40. And as the future or stock began to move backwards, all he would do is simply shift columns, go down one box and reverse the order. 39, 38, 37, 36, 35. And the reason he shifted columns is because you can't overwrite the column you just wrote figures in. So as the stock began to move back upward, or commodity, he would reverse the order and simply shift columns and write 35 or 36, 37, 38, 39, 40. And as it fluctuated again, he would shift columns and simply write the price of the stock backwards. So what you ended up getting was a very interesting chart pattern that was just as clear as could be, that looked exactly like this. Now this could be Microsoft, this could be the Canadian dollar, whatever it may be. But notice here, when you're looking at this chart pattern, that as a general rule, or it has a tendency, as the stock is recording upwards, notice that each time you move into a column that carries the stock, it carries the stock higher than it previously did. So as the stock is rising in price, and as Charles Dow would simply write the price of the stock in the box, each time it's in an up move, it has a tendency to go higher than it previously did. So that gives you an idea of what's happening with demand. But on the same token, notice that as the stock begins to decline in price, or the future, it has a general tendency not to go as low as it previously did on the previous decline. So what would this suggest to you about supply and demand? It would simply suggest that demand is getting stronger, supply is getting weaker. So already you can see how, in a logical, organized way, this chart gives you a wealth of information. Then notice up here at this level, notice this pattern. If I were to circle this and have you come back to your 10th grade geometry, tell me what this looks like. This little right here. Does that look like a trapezoid or a square or a circle? Anyone? Looks like a triangle formation. Exactly. Anyone sees this. From a 10th grader to an 80-year-old is going to see this as a triangle. This is one of the most important patterns that we look for as far as patterns are concerned in the point and figure method. So a person that isn't even familiar with reading charts whatsoever, as most of you are, if you weren't even familiar with this, you could already see that there's a benefit to looking at a chart like this. Already you notice that the higher highs and higher lows are producing a chart that's clear that demand is in control, and you reach a point where all of a sudden you can see a pattern, and the triangle formation is something that we look for as much as we possibly can. So it wasn't until the early 1900s, and what they did is they called that figuring, because Charles Dow wrote the figures of the price of the stock in the boxes. The early 1900s, they changed this around a little bit. What they decided was that instead of using the figures in the chart, they would put the figures of the stock on the vertical axis, instead of taking the time to write the figures in the chart. So they put the vertical axis as the price of the stock, and then what they did is simply put checks in the boxes. They just simply wrote a check in the box. So you have the exact same picture, only made up of checks. And then they changed that to X's. And around 1920, they made one more change that hasn't changed since 1920, is when the stock is beginning to move upward, as Charles Dow would write the price of the stock from 30 to 40, they used the letter X. And when the stock began to retrace, as Charles Dow would reverse the order and write the price of the stock down, they used the letter O. So the O was representing supply, the X was representing demand, and the only reason they made that change was it made the charts much clearer, and you could see the tops and bottoms of the charts much clearer, and the patterns came out much clearer. So you had your choice back then of either figuring, or in the early 1900s, they used to use only 1-point charts, 1 point per box, and they called those point charts. So if you were doing this methodology, you could use the figuring way that Charles Dow did by writing the figures of the stock in the box, or the new way of using the points, 1 point per box, you could actually use the X's and O's. So they call this point and figuring. And it hasn't changed in over 100 years. This methodology has not changed at all. We use a 3-box reversal method, which we'll get into in a moment. Back in the early 1900s, they had 1-box and 2-box reversals that tended to give you more signals. It's basically flattened out now to a point where we found that 3-box reversal gives us the best signals, but we'll cover that in a moment. But the next chart I want to put up here really shows you what the commodity business or stock business is all about. Here's a guy who's talking to his boss. He says, we've got a slight problem. Notice the supply box is full, demand box is empty. If you have purchased a future at any time in the near future or last year or so and had it go against you, that's the reason. The supply box was full, demand box was absolutely empty. There is no other reason behind it. Now, there are probably fundamental changes that cause this imbalance between supply and demand, but the net result, whether you're in the futures market or in the stock market, and probably even more so in the futures market, is if there are more buyers than sellers willing to sell, the future's going down. If there are more sellers than buyers willing to buy, if there are more buyers than sellers, the future's going up, and more sellers than buyers going down. If buying and selling is equal, it's going to remain the same. There really is nothing else. You can put a square root over the top of it. You can call it a Fibonacci retracement. You can call it whatever you want. The net result is the imbalance between supply and demand is what causes stock prices to move and commodity prices to move. It's the same thing that causes produce in the supermarket to change prices. The exact same reason. If any of you remember this summer, a head of lettuce cost $2.09 a pound. You remember that in the supermarket? There's a reason for that. It's not the produce manager coming out trying to raise the profit margins of the store. There was probably a flood somewhere. Something happened to upset the supply and demand relationship of lettuce, and the price went to $2.09 a pound. So what we try to do is get a good handle on the supply and demand relationship of the underlying future. And what happens here is, basically what happens with the way futures trade is the supply box remains full, demand box gets full, sometimes the boxes are equal, but the net result is the imbalance between supply and demand that causes the whole thing. The next chart I want to put up here comes out of the book, The Three-Point Reversal Method of Point and Figure Technical Analysis by A.W. Cohen. You want to stack as many odds in your favor before you start out on a trade. You can't haphazardly go in and trade these things back and forth. Think in terms of a basketball player for a minute. In a basketball game, a guy is dribbling down the court and he's about to shoot the ball. He makes a jump shot and somebody hits him in the hand. They stop the play. This guy just gets a personal foul. That means he has 2 free throw shots to make. Each one is independent of the other. So before he starts to make his free throw, he's standing on the free throw line, getting ready to shoot, and the commentator has a computer. He hits the computer button, and he sees that Joe is a 70% free throw shooter. Because in today, whenever you watch the games, we know the probabilities of everything that everybody does in today's computer age. So he knows that Joe's a 70% free throw shooter. That means that 7 times out of 10 that he shoots the ball at the basket, it's going to go in. Now he has 2 shots to make, each one independent of the other. So if he's a 70% free throw shooter, anybody here, tell me what the probability is that he makes both shots. 49, exactly. 0.7 times 0.7 is 0.49. So Joe is going to be less than successful over time if he's a 70% free throw shooter and he has 2 shots to make. You as an investor or trader must do 2 things correctly to be successful in the futures market, period. You have to buy the future right, you have to sell it right. Any of you here ever bought a future and had it rise and then come back down again before you sold it? Has that ever happened here? May not have. Sometimes in Virginia we didn't get the benefit of the rise, but that can happen too. We've had to go straight down before. But the same idea, same concept is, if you're a 70% picker on the futures market, you probably have a less than even chance of making money. So how can I increase my probabilities of success? One way is to look at different chart patterns. And some of the patterns that we're going to cover in just a moment, I think I've already misplaced my, where is it? Oh, here we go, right here. These chart patterns were done by Purdue University on an IBM computer, and it was done from buy signal to sell signal. Professor Earl Davis is the person who completed this task. He was a chemist at the Purdue University. He also wrote a book called Profit and Probability. And the computer went from buy signal to sell signal. So what has happened here, and this was done on stocks, not commodities, and commodities work just as well, but I want to show you the probabilities, that if you're willing to wait for a particular chart pattern, in this case in a bull market, and you could translate that into a condition in which, let's say, sugar was in a bull market, or the foreign currencies were in a bull market, or the market was supporting higher prices in general. If you waited for a triple top buy signal, you should be right 87.9% of the time for an average gain of 28.7%. Should take 6.8 months. Now in futures, this can be taken down to 6.8 days. The important thing that this shows you is the statistical study that was done on stocks And I think as fast as futures move, it's even more valid, because the faster chart patterns form, the better they are. So you can see if I will wait for a bearish signal reversal, I'll be right 92% of the time. And we'll almost in every case, if we see a bearish signal reversal form in a future that's in an uptrend, we're going to take it every time. On the downside, if you're looking at selling short, these other probabilities might kick in, where if you're in a bear configured market, where let's say the Canadian dollar is in a bearish trend downward, you might expect these types of patterns to come into play. The triple bottom would be right 93.5% of the time for an average gain of 23% saying you're short, and should take 3.4 months. You can shorten that up considerably for futures because of how fast things move. The point with the whole study is that you can increase your odds of success if you wait for particular chart patterns to form, rather than just jumping in and haphazardly buying the future. So in many cases, what we will do is, as far as our futures trading is concerned, we'll watch for futures that are beginning to bottom out and create these types of charts that we're going to see in just a moment. So the idea is to be able to increase your probabilities of success before you start out. There's a number of things that you can do to help yourself become more successful. Let's start with the first chart pattern. And I want you to look at this so carefully here, because you're going to see this double top and double bottom the most of any chart pattern in futures. This is what you're going to be trading mostly. I want you to understand what a buy signal and sell signal are. Think back to the chart that Charles Dow was recording just by writing the price of the stock in the boxes. Notice here where we have written the price of the stock in the vertical axis. And in the 1920s, remember I mentioned they changed it around. Instead of writing the price of the stock in the boxes, what they did is they assigned the letter X to be demand, the letter O to be supply. So we watch the same battle between supply and demand, yet in this case it's much easier to see rather than writing the price in the boxes. So what I do is with kids in Richmond, Virginia, at times in the past I've gone into Gates Elementary School and Midlothian Middle School and taught children the point and figure method. The beauty of the kids learning it is they usually pick up in about 40 minutes what normally takes an adult about a weekend to catch on to. You don't have to deprogram the kids. They're really refreshing. But, and I'm going to give you some quizzes along the way this morning to see how you're doing in relation to Gates Elementary School. You're going to be okay, though. I'm sure everyone's going to be fine here. We're out in California. At any rate, notice here that each box size here is 1 point. And you could use this as 1 point or 0.10, whatever it may be. What's most important here is I want to show you how the chart pattern is formed. As this future begins to decline from the price of 45 or 4.5, each time, if you're in one column and you're moving in a particular direction, every time this moves down one more box, in this case, we'll record it by writing the letter 0. The future comes all the way down. It continues down moving. Let's say each day it moves down one box further. We record that by placing a 0 in each box. Finally, the future gets down to the price of 31 or 3.1 and stops. It stops moving any lower. So think back to that box where the supply box was full and demand box was empty. What do you think the supply and demand boxes look like at this level? If the future comes down to the price of 3.1 or 31 and kind of stops, doesn't want to go any lower, what's happened is supply and demand has gotten equal. That's exactly what's happened here. The key to the point and figure chart now is how you shift from one column to the next. That's the key. Shifting from one column to the next. We use a 3-box reversal method. It takes at least 3 box changes to shift from one column to the next. Now, what I do with the kids is I have them look at this as a tennis match between John McEnroe and Jimmy Connors. We'll call McEnroe, he's the bad guy at tennis, so we'll call him, he's usually in trouble, so we'll make him the letter O, and the letter X is Jimmy Connors. We'll make him the rising in price. So we watch the battle between supply and demand, and we're only interested in the outcome of the overall tennis match. Now, there are a certain number of games within the match and matches and sets within the match. Games within the set and sets within the match. We don't care about those sets and games. We're interested in the culmination of the match. Now, as the future continues to move down here, it comes down to the price of 31 and refuses to go any lower. All of a sudden, it begins to reverse back up, gain some sponsorship, and starts to rise back up here. But before it can get into a column of X's, it takes at least a 3-box reversal. Now, this is key to the whole point and figure. Now, I want you to listen to this very carefully. At the 31 level, and we can call this the Canadian dollar when it was down at 31, it will take a move up to 34 to begin to be significant enough to record. The bar chartist would record every insignificant move, and that's why bar charts are hard to understand. If this future moved from 31 to 32 to 33 and 7/8, it could move back between 33 and 7/8 and 31 for 6 months, and you'd never record anything. Nothing would go in the box. It would take a 3-box reversal. Actually, in this case, a 3-box reversal is 32, 33, 34 from that 31 level to be significant enough to record. So this future could jump back and forth from 33 and 7/8 to 31, and you would do absolutely nothing. All of a sudden, from 33 and 7/8, it hits 34. Now it's significant enough to write the first, second, and third X. The future is now rising in a column of X's. Each time it moves higher, each box, you will record it by putting an X in the box. But you can only shift from X's to O's now. How can that be done? Anyone? 3 points, precisely. 3-box reversal. Okay, 3-box reversal method. I want you to understand that clearly, because this is how the charts are formed. The ease with which a point and figure chart is created is simply that. It's the key to the whole chart is the 3-box reversal method. So let's go back once again. I want you to understand this clearly. The point and figure chart comes down, the future comes down to 31. It can only reverse into a column of X's from the price of 31 if it hits 34. That's a 3-box reversal. We go up to 32, 33, 34. From this level, for whatever reason, the future finds supply and then reverses back down again. Now, what might cause that? You may have a particular trade where the future was coming down here at the price of 34. You bought it and immediately went to 31. One of the first things you may be thinking about is, my God, if it gets back to 34, I'm getting out. So you may have a sell order there at the price of 34. The future comes back up to the price of 34. Mr. Joneses and Mr. Smiths of the world create a sell order for whatever reason, and it reverses back over. The only way you can move from X's to O's is a 3-box reversal method again, by moving down from 34 to 32, 33, 32, 31. It finds sponsorship again at 31. And how can you reverse back into a column of X's? 3-box reversal again. So what's happening here is the future is moving from one column of O's to a column of X's, from a column of O's, and the tennis match is on. In this last column, the future moves back up to the price of 34. This is the point we call resistance. Why is it called resistance? Because the future is resisting going any further than 34 previously. It got to 34, found supply, and reversed back over. The second attempt at 34, the question is, are those sellers still there that caused the future to decline before? We don't know that until we see how it negotiates that level. This time the future gets back up to the price of 34, exceeds it by 1 box, and that tells us the sellers that were there are no longer there, and you have your most basic buy signal. Register this in your mind. What a buy signal is in point and figures is, it's a point at which the future comes up to a previous level that forced it down, or a previous level of resistance, and exceeds that level. So our buy signal in this case is, here's the resistance level at 34. The future was forced down because supply overtook demand. It comes back up again to that same level on a 3-box reversal, hits the same level, and then exceeds it by 1 box. That's your most basic buy signal on the futures. This is going to be the one that you deal with mostly. On sell signals, the opposite takes place. Notice here the future moves to the 45 level. For whatever reason, finds supply. It moves back over into a column of O's. Now, how can it get into a column of O's from X's again? 3-box reversal. Anything less than 3 boxes, would that be recorded? No. So this future, when it's at 45, must decline to 44, 43, 42 before it's significant enough to record it. In this case, it reverses back to 42. For whatever reason, the Mr. Joneses, Mr. Smiths, or corporations of the world or whatever come in and buy it. It forces it back up to that previous level that found supply. It happens once again. It reverses back down on a 3-box reversal, comes to the level that formerly found sponsorship, except this time it doesn't. So here, we formerly had a condition in which there were buyers. This time it comes down to that level. The buyers are not there. It exceeds it by 1 box, and we have our most basic sell signal. Now keep this in your mind. What is a sell signal? A sell signal is a point at which the future comes down to a previous level that found sponsorship, except this time it's not there, and it exceeds that level. This is called support. the support level. So in the point and figure charts, a buy signal is a condition in which a column of X's exceeds a previous column of X's. A sell signal is a column of O's that exceed a previous column of O's. The X represents demand, the O represents supply. Now, if I were drawing trend lines, and we're going to get to those in just a moment, when a future makes a bottom and gives the first buy signal off the bottom, the trend line in the point and figure chart never deviates. It's always a 45-degree angle. The bar chartist will typically take their protractor and just connect the prices as they see fit. The point and figure chartist is always a 45-degree angle. So at the bottom, when this gives the first buy signal at the bottom, I'm going to come to the lower part of the distribution and simply connect the boxes up horizontally. That will always be your bullish support line. And we'll see many of these in a moment. And it's imperative in the futures business to be able to shift that bullish support line. The bearish resistance line is made when a future makes a top, gives the first sell signal off the top. You can begin connecting the boxes on the way down, which will be in the reciprocal of a 45-degree angle. I think that's a 135-degree angle, but it's the same 45, the same way, just connecting the boxes. This is called your bullish support line, and this is called your bearish resistance line. We're going to cover those in depth in just a moment. But it's always a 45-degree angle that will never change. So you don't have to worry about connecting prices here. The triple top buy signal that we have seen, oh, no, here's another one on the double top. The next one's a clue. Notice here notice the two charts here. Look at them carefully. I'm going to put one up in a second that's going to be a little bit different. And I want you to tell me what you see that's different. There's a clue in this about the supply and demand relationship. Take a look at this one. What's the clue here? And if any of you can't see too well from me on that side, switch over. Precisely. That's it. The rising bottoms. Here you have a situation in which supply wins a set, demand wins a set. Supply wins a set, demand wins a set. But let's come back and look at this column right here. Although supply wins this set in the tennis match, it's unable to do it as convincingly as it previously did. So what you have here is called a rising bottom. Even though supply took over during that period, it didn't go as low as it previously did. So it gives us a little bit of insight into the chart pattern. Not only do we have a condition where demand has won the match by giving a buy signal when it exceeds a previous top, but this little piece of information tells us that not only is demand in control, but supply is becoming less significant. The opposite is true here. In this chart, you can see the exact reciprocal. This stock finds support here the first time, comes back to the same level that found sponsorship previously, but it's not there. It slips through that level by one box, and you have your most basic sell signal. Notice this column, though. This column suggests that although demand took control of the future at that level, it was unable to pull it as high as it previously was. So it tells us that demand is beginning to dry up, so we'll probably be more aggressive on this sell signal. Now we're going to put this all together in a couple of moments. I just want to show you these static chart patterns first. The triple top formation has one of the highest degrees of probability, and as you can see, it's called the triple top simply because the future has risen to a point 3 times and then exceeded that level by one box. So we call this the triple top. If you can find these patterns in a future that is bottoming out and beginning to break the bearish resistance line, and we'll see a few of those in a moment, those are the ones you really want to look for. They give you a good high probability of being successful in the trade. The triple bottom formation can be extremely profitable on short selling. This is the exact opposite situation in which a future comes down to a particular level and finds sponsorship twice. It comes down to the third time to that level. This time there's no sponsorship there. The buyers that forced it up previously are no longer there. Supply overtakes the stock or the future, and you get your sell signal at that level. Sponsorship was found twice right here. The future comes back to that level again and exceeds it by one box. So this can be an extremely profitable pattern, which we'll see a few in a moment. In fact, what I brought is a number of trades that we have made over this last year that Sue has made in our commodity account to show you exactly how we handled them. The triangle formation. Remember looking at Charles Dow's symmetrical triangle. By looking at the price of the stock or the future that he was writing in the boxes, all of a sudden you came to a level and there's a clear triangle. That's exactly what we look for. These are extremely profitable. These patterns are very profitable, the triangle formation. The beauty of these is you can see them so easily. All of a sudden you reach a point where you get a series of lower tops and you get a series of rising bottoms. The triangle formation is as clear as can be, and we'll see a few in a moment. The breakout on the upside, we'll normally always go with the breakout and not wait for the pullback. The opposite is true on the bearish triangles. The exact same pattern is formed. You get the breakout on the downside, and the move is on. Extremely profitable. Watch for the triangle formations. The catapult formation now, I want you to tell me what you see here. You tell me now what you see. Pick this apart as if you were in the 10th grade again writing a 100 words or less essay on what you see. Take this left-hand side here and give it to me one at a time. What's one of the first things you see?
I see two double tops.
Okay, we see a double top right here. Here's one of the first things. What else is in that chart pattern? Anyone? Rising bottom. There's two. Double bottom. Three. The stock has held twice. It's come down to a level, giving you good support. One more piece. The triple top. Right here. So there's your triple top buy signal. The catapult formation, as you can see the way this thing looks, it looks just like a catapult throwing the future up. You have a condition in which your triple top buy signal breaks out, and you probably would have gone on that signal. The next reversal back down, notice it comes down but does not go as low as it previously did, suggesting supply is drying up. Then it reverses right back up and gives another double top buy signal. Sugar did this last week and broke the bearish resistance line. The opposite is true here. This is a very, very negative pattern. If you find a future that's breaking the bullish support line, which we'll see some of these in just a moment, you have the triple bottom sell signal here. The future reverses back up, but notice it can't go as high as it previously did, so it just simply shows you that demand is in control there, but not as strong as it previously was. The move goes back on again, and you have a confirming double bottom at this level, and that's as deadly as can be. If you are long a future that does that, you've got deep trouble. So watch these extremely carefully. And you can maintain your futures charts by hand every day in probably 15 minutes. The bearish signal reversal. This is the one that has the 92% probability of success. You don't see it very often. If you were to look at this pattern, and I'm going to cover it up here, what you see is a series of lower tops and lower bottoms. You can't get much more negative than that. Notice the future moves down here. Just every time demand is in control, it can't go as high as it previously did. Supply takes over and it goes lower and lower and lower. Then all of a sudden, without a period of accumulation, in other words, without the future moving sideways and then breaking out, all of a sudden it begins moving back up in this one line, not overnight, but moving back up in one column, gives that double top buy signal right here, basically breaking this series of lower tops, and you have a situation where there's probably a major fundamental thing taking place, a change that most people are not aware of. This is the one that has a 92% probability of success. The opposite is true here. When you have a condition in which you have a bullish signal here where each top is higher and each bottom is higher, what this is saying is each period of demand this rises, it's getting stronger, and each time supply takes over, it can't go as low as it previously did, so you have a major supply and demand imbalance where demand is clearly in control. Then all of a sudden, without a period of distribution, in other words, without moving sideways, it comes down in one column, exceeds this bottom and the series of higher bottoms, and you have your bearish, your bullish signal reversal. Extremely dangerous on this one also. So we want to watch for these types of patterns, although you don't see them very often. You're normally dealing with the double tops and double bottoms. Now, let's get into the fun part. First thing is trading rules. Now we accelerate here into actually trading these things. The rules of trading, if you will stick with these rules, and I'm telling you, don't deviate through them. Someday you got to get religion. And whether you're trading stocks or you're trading futures or whatever it is, you got to get religion someday. This is the day. Rules and regulations. Only trade long when the commodity is above the bullish support line. In other words, let the trend be your friend. If you were to ask somebody, what's the key to success in commodity trading, the first thing they would say is only trade with the trend. Let the trend be your friend. Keep your losses short and let your profits run. Well, that's a pretty trite thing. We all know that, right? Well, how can you develop a systematic approach, a logical, organized way of doing it? This is the way you can accomplish those three goals. First one is trade only long when the commodity is above the bullish support line. Second, only trade short when the commodity is below the bearish resistance line. These rules cannot be broken. If the commodity is trading above the bullish support line, which we'll look at in a moment, you cannot go short no matter how desperately you want to. You must only trade long. Trade only below the bearish resistance line. If you are long, remain so until you receive the first sell signal. Here's the key. And one of the things that made us so successful over this last year is the ability to stick with a trade. How many times have you had a trade that's working out well for you? Let's say you bought the Swiss franc and it's working out well, you're up 1.5 points, and you sit back and say, oh my God, I need to take that trade to make up for the bean oil I just lost on the other day. So you take that trade to make up for that to start even again. I mean, how many times does this happen? It's happened to everyone here. But in this methodology, if you are long a contract, you must stay long that contract until you receive a sell signal. What's a sell signal? We just looked at that. Remember the double bottom where the future came down, held at a particular level, 3-box reversal method, moved back upwards, came right back down again to that level and exceeded by 1 box, sell signal. So if you are short a future, you must remain short until you receive a buy signal, period. Rule number 3 is there are no exceptions to that rule. Next rule, never trade against the trend under any circumstances. That goes right back to number 1 and 2. Raise or lower the bullish support line or bearish resistance line whenever possible. When you get the first bullish support, when you're in a bullish support line, you will raise the bullish support line when you receive a sell signal followed by another buy signal. You will lower the bearish resistance line when you receive a, let's see, you'll raise the bullish support line, okay. Lower the bearish resistance line when you first receive a buy signal followed by another sell signal. This is one of the most important parts of it all, is to be able to lower and raise your trend lines. But they've got to be in a logical manner. You're not going to do it the same way that you have with bar charts in the past by taking your protractor and just connecting boxes. There's a logical, organized way that we're going to do this. If the underlying commodity breaks the bullish support line, begin to trade short. In other words, as long as that bullish support line is held, you'll be long. But if it breaks that trend line, you'll start trading short. If the underlying commodity breaks the bearish resistance line, begin trading long. When you are long a contract, continue to raise your stop point each time a new sell signal is created. In other words, managing your trade is extremely important. If you are long a future, each time a new sell signal is created, you'll raise your stop point to that level. We'll see all these in just a moment. I want to outline the rules and regulations. When you are short a contract, you will lower your stop point to each buy signal, new buy signal that is created. Diversify whenever possible. It's good to be both long and short. And there, to the top, one exception to the stop points is if we have a future that runs 18 points unchecked. In other words, if it runs in one contract or one column, 18 points up or down, without a reversal, we'll stop out on the first 3-box reversal and go right back in on the next buy signal. Now let's look at how we handle each one of these. Let's take them one at a time. Those are the rules and regulations. First thing is trend lines. We just looked a little bit at a trend line. I just want to show you these two trend lines simply to show you what a bullish support line is and a bearish resistance line. First thing is look on the right-hand side here. The bullish support line, all I want to show you here is it's a 45-degree angle. That's all I want to show in this chart, is that you connect the boxes up. It's a 45-degree angle, will always be that way. The exact opposite is true in the bearish resistance line. What's important here is how the line can shift out 1 box. Notice here, and you'll see this in some of the charts, when the bearish resistance line is coming down, and the future moves up to that line but does not exceed it. In other words, if the future comes up and hits the line, does not exceed it, and then falls back, you move the line out 1 box. So notice here, we had the bearish resistance coming down symmetrically. The future comes up and hits it right on that box. It doesn't break the trend line, so we move it out 1 box. It comes down here again. The future hits it at this level. We move it out 1 box. So each time a future hits a trend line but does not exceed it, we move the trend line down 1 box. All I want to show you on this chart is how these look. These are 45-degree angles and no deviation from that. Next trend. Sugar. Looking at trend lines here, I want to show you how we can raise and lower. Listen to this carefully. The sugar chart comes into play from up in this level. So we have our bearish resistance line that's drawn by connecting the boxes. The bearish resistance line, let's see if we can do it with the pointer here. Bearish resistance line comes into play here. The way you move a trend line is this. As the future comes down, notice each time it's giving consecutive sell signals by exceeding a previous bottom. Continues on down. Then all of a sudden you receive your first buy signal. We stop on every, if you are short a contract and below the bearish resistance line, your stop will be every buy signal. So you theoretically would have been short this contract all the way down to this buy signal. Now this buy signal stops the trend, the downtrend, but is immediately followed by a sell signal. The way you lower a trend line in a bearish resistance when the future is below the bearish resistance line is if a buy signal is given, followed by a sell signal. The buy signal effectively takes the sell signal off. Once the sell signal is re-given again, in this case, lower the trend line to the top of this distribution. So we come right down to the top of the trend line here, and that's our new bearish resistance line. You can erase this one. Let's go through it again. Here's the bearish resistance line, the original long-term trend. The trend is down. You never see a buy signal here. Notice you never see a column of X's that exceeds a previous column of X's until finally you get down to a point here. Remember your double top buy signal? This is what you see right here. That effectively stops your trade out. Tremendous trade. You're short all the way down. You're stopped out on the buy signal. Yet the trend line now is moved down to this level because the new sell signal puts it back in a downtrend, and you lower your trend line. In this case, the future finally bottoms out. It gives a buy signal, but then comes up and exceeds that bearish resistance line by one box. Once it exceeds that bearish resistance line by one box, the downtrend is over and the uptrend begins. Now what's important here is when the uptrend begins, it exceeds this level by one box, come down to the bottom of the distribution and connect those boxes up horizontally. Remember we talked about just connecting the boxes up in a 45-degree angle. Let's cover this once again. We moved the trend line down from the long-term trend line. We moved it down because we got a buy signal followed by a sell signal. The trend line then becomes our bearish resistance line. When this future then exceeds that trend line, breaks the trend line on a buy signal, which this does, right up here at the, looks like 1060 level, that now becomes a bullish chart pattern. We go to the bottom of the trend line, or the bottom of the distribution, and connect the trends up horizontally. This then breaks that trend line again on the downside here, making this future bearish again. We go top of the distribution and connect the trend line back down. The net result is, finally the future makes the bottom here, gives the buy signal, breaks the bearish resistance line again, and we connect our bullish support lines. I'm going to show this to you in another way that will make it a little bit simpler to see all the different changes. But now notice with the future above the bullish support line, you can only go long. Even though this sell signal looks like it produced a good short, the only play above this bullish support line is a long position. Let's look at another chart that will, I think, illustrate this a little bit easier. Sugar again, March contract. Again, we come into the trade with the long-term bearish resistance line intact. We get the first buy signal off the bottom, which effectively stops your short. It's followed over here by a sell signal, which allows us to reduce the bearish resistance line to this level. This is the chart that I wanted to show you has the bullish catapult. Notice the condition here, where you have the triple top buy signal, followed by the pullback, and then uptrend resumes again. This is where we went long sugar last Friday, or last Thursday. And it has pulled back a little bit. We're prepared to go back in another contract. Our sell signal will be the double bottom if it takes place right here. Now, as far as trend lines are concerned right now, that's all we're talking about now is trend lines. Notice the bearish resistance line. When it was broken, that allowed you to go long the contract. Now, the trend lines must be moved whenever possible. Let's look at some more ideas on trend lines here. Here is an example of exactly how you would trade a whole future. The commodity, this commodity trading, the future comes into play in the bearish resistance line, trading below the bearish resistance line. The first sell signal that takes place, you would go short. You will take every sell signal and stop on every buy signal. So it's below the bearish resistance line, so we take this sell signal and we sell short. The future then comes down, continues to make another sell signal, eventually gives that first buy signal, allows us to cover our short. The buy signal is then, we do not go long, we cover the short, we receive another sell signal right here. We not only go short, but we're able to lower the trend line now. Because we received a buy signal, followed by a sell signal, lower the trend line down. Now we're still short the contract. You remain short until you receive a buy signal. This contract stays short, stays short, stays short, until finally you get your first buy signal off the bottom on the triple top. That not only gives you a triple top buy signal here, but breaks this trend line. You go long on this and play long the contract, draw your new bullish support line at the bottom, and connect the boxes up horizontally. Now you're long the contract. You will stay long this contract until you receive your first sell signal. And this is the beauty of this, is it'll force you to stay long a contract. We have made some currency trades that were astronomical simply because the currency continued to rise and never did develop a sell signal until it really took off. So you could end up making 6 or 7 points in a currency trade when you were itching like crazy to take a profit on the first point. This forces you to stay with the position until a sell signal develops. So we're now long the position. The bullish support line has been drawn on a 45-degree angle. We will stay long as the future stays above this trend line, and we are on a buy signal. But notice, the buy signals continue, no sell signals until this level. This level covers our long position, but we do not go short. Why don't we go short on that cover? You're above the trend line, exactly. When you're above the trend line, above the bullish support line, you must trade long only. No deviation from that. Notice here, though, the future gives a sell signal here, which forces you to stop your position out. You take your profit on that point, but it's still above the bullish support line. So our next play at this point would be to go back in on the next buy signal. Yet before the buy signal develops, we get our second consecutive sell signal here. But notice what this sell signal also does. What does it also do at this level? It breaks the bullish support line. When it broke the bullish support line, now we are trading short. Okay to go short now, and you would draw your bearish resistance line by going up to the top and connecting the boxes down. We will stay short now as long as that future stays where? Below the trend line. We'll cover that short position on the first buy signal. If the buy signal breaks the bearish resistance line, we will go long. Notice this case, we go short here, the future comes down, gives us a buy signal, and breaks that trend line. We cover our short and go long the position here. We stay long position now as long as the future stays above what? The bullish support line. We'll cover the long position on the first sell signal. And if that sell signal still keeps the future above the bullish support line, will we go short? No. So the future then rises up here to a point where we get our first sell signal here. That stops out, that first sell signal here stops out our long position. But it's still above the bullish support line. So what do? We are prepared to go back in on the next buy signal. The next buy signal takes place, you can hardly see here with all the lights, here, and you go long again. So the logical sequence of events here, number one, let's go back again. We must always trade with the trend. In the beginning of this trade, the trend was down. So we always play short. As we came into this chart, we were short the contract. We will stop the short out on what? The first buy signal. How can we lower the trend line? A bearish resistance line can be lowered when? You get a buy, then a sell. The buy signal effectively stops the sell that's in play. The subsequent sell signal, again, puts it back in play, and in essence creates a new top. Because that buy signal that's given stops your short position, gives you a top, and you know it's a new top because it was followed by a sell signal. So that's the only way you can change trends. Once again, when you're in a bearish trend, below the bearish resistance line, you receive the first buy signal, followed by a sell signal, lower the trend line, and that's what you operate from. In a bullish trend, if you're above the bullish support line, how can you raise the bullish support line? As the future is rising, if you receive a sell signal followed by what? A buy signal, you can raise your trend line to that level. It's imperative that the trend line be raised. Let's look at some more examples of this. Here's a case on the Canadian dollar and how you would raise your stop points. Notice the bullish support line. The future comes down, makes a bottom. We have our bullish support line. Finally, we cannot go long the future until this level. Why can't we go long until that square? And this is an actual trade that we did. Because you're below what? The resistance line, right? This is your bearish resistance line. And if the future is below that, in other words, if you're below the trend line, you cannot go long, can you? Well, it doesn't break the trend line until this level, does it? So that is the only and earliest point that we can go long the contract, right here. So once we're long the future and it breaks the trend line, number one, where is my first stop going to be? If we are long the contract, we will always stop out on the first what? Sell signal. Any sell signal that develops, any sell signal, stops your long position out. So I go long here and I know exactly where my sell signal will be. If this future from this level, I go long at this level and it reverses down here to a point at which I exceed a previous bottom, that would be my stop. I'm lucky in this case that that doesn't happen. But the second I enter a future long and I buy on a buy signal, I know exactly where my stop is going to be. My stop will be the first sell signal that develops. Now, in this case, we're lucky. We buy the future when it breaks the trend line. It pulls back a little bit, scares you a little bit, comes back to a support level, reverses back up again, and moves higher. Now, how can I raise my stop? Your stop, since the rules suggest that every sell signal that's given will stop your position out. So my original position, when I buy the future here and the trend line break, I know my stop point is here. That doesn't happen. The future then rises up, pulls back, gives another buy signal here, and basically raises my stop to this level. Because a sell signal would be given from this buy signal if it reversed in this way, if it reversed down, and remember what a sell signal is? It exceeds a previous bottom by one box, then that would be my stop. So I raise my stop to that level. But notice, it doesn't happen. The future then rises up further, pulls back, rises again. My new stop is at this level. Now it rises even further, pulls back, rises again, sets up another double bottom. So any point at which it sets up a new sell signal will be where I move my stop. So you will stop on every sell signal. The simplicity of this is, once I go long on breaking the bearish resistance line, every sell signal that's developed will be my stop point. Hopefully, I will continue raising it as far as can possibly be before I get stopped out. But any sell signal that develops, a sell signal is your basic double bottom or worse. In this case, the future rises all the way up until finally, there's your point where the first sell signal is given. So we got a tremendous ride from this level all the way up to this level, where I think many commodity traders would have stopped out way earlier. The reason we were able to get that ride is because rule number one, if you are long a future, you will stay long until a sell signal is developed. Wherever that is. If you have to sit with your position for 3 months, hopefully you're still in an uptrend. But you can't stop until the sell signal develops. December corn, raising your price, raising your stop. Our entry point in the corn. This is the December corn, picture here, we weren't trading the contract in this level. When we came into the contract, this was the first buy signal that was given, and we bought this future at 90 or 2.93. We held the position. Notice our first stop point would be at this level. Why is our first stop point here? First sell signal that develops. Our next stop point, we were stopped out finally when the future went all the way up here, corn went up, came back and gave this sell signal right here. That was our stop point. That stopped us out at 3.07. So our bullish support line was drawn down here. The future came down, made a bottom. We couldn't go long until it broke this bearish resistance line. And once we went long, we will stop out on every sell signal that's given. May contract in corn. Entry and exit points again. First contract we entered, and these are actual trades that were done by us. Notice the bullish support line. The first trade that we get in is right here in March. Notice the 3 in the chart represents March. This is your basic double top buy signal. We go long the contract on this double top. Where will our stop be from that level? The first thing you know, it'll be on the first sell signal that develops. Where is the first sell signal from that level? Let's say all things went wrong and the future reversed on down from this box that we have a square in. That's where we went long. If this O continued here to this level and broke right here, we would be stopped. But this doesn't happen. The future then rises, moves back, rises again, and the first sell signal that actually takes place is at 248. That's where our position was stopped out. Now also, not only were we stopped out, but notice one other thing happened here on that stop point. What else happened in that level? What happened to the trend line? The trend line was broken. That effectively made the future bearish, and you would now play short. Because this long-term trend line was broken, you can draw your bearish resistance line, and now enter your short positions. Managing money is probably one of the most important parts of the trade itself. We typically will only risk $500 per contract that we trade. Now, we'll increase that whenever we trade bonds or we trade currencies. We're willing to increase that, but we try to keep our losses on bonds and currencies between $500 and $1,000 because of the size of the boxes. Now, you have to determine exactly what your amount of money is that you're willing to risk. Now, in some cases, you may receive a buy signal right here at this level, and if you count down and you say, okay, here's my buy signal right here at 2.44, what's my stop point? Well, I'm going to risk 1, 2, 3, 4, 5 boxes, and you come to the realization that 5 boxes or half a point is too much for you to risk. Then what you have to do is adjust your entry point. If you can't take the trade at this level because the loss is too great, you can always initiate a buy on a pullback. Let's look at how that might work. The entry and exit points. Here's a case in point. The bullish support line is trading above the trend line. We wanted to go long on this triple top right here. Do you see the spread triple top formation? Here's a case in which we get a nice spread triple top. You don't often see it. 1, 2, 3 times. We wanted to go long on the breakout. But when you counted up the number of boxes that we were going to risk, it was too great. If we went long the contract right here, where's my stop? My stop is 1, 2, 3, 4, 5, 6, 7, 8, 9 boxes. The risk might be too high at that level, so Sue chose to go in on a reversal. If I go in on the reversal, the buy signal is still intact, yet it gets me to my sell point, my stop point. So we simply entered an order on a 3-box reversal. This buy signal is still intact. Our 3-box reversal came into play right there, and we happened to luck out that it did in fact come back 3 boxes. We could have missed the trade. I mean, the triple top could have continued carrying the future higher. But because we wanted to adjust our risk-reward characteristics, we entered the 3-box reversal. So we got into the position right at this level. Eventually what happens is, notice even though you get a lot of fluctuation, you still don't get a sell signal. The future comes down 3 times here to this level, but no sell signal, until finally we're stopped at 2.75. What this did is it forced us to hold the position to that level. But now that July corn was still above the bullish support line, which way do you trade? Long. You cannot trade short above the bullish support line. So if by sticking with these rules and regulations, it makes it relatively simple. Probing the trade. In many cases, here's another thing about the reason that you continue to move back in. Let's say a particular contract is above the bullish support line. You buy the contract, it rises a little bit, and then stops you out, and you take a loss. You're still above the bullish support line. What do? Go back in on the next buy signal, exactly. Let's say the next buy signal goes up a little bit, pulls back, and stops you out for a $300 loss. You're still above the bullish support line. What do? You go back in on the next buy signal. What you're doing here is you're probing the trade. In most cases, you'll never find a trend unless you're willing to work for it, unless you continue to work for it. In this case, we went short this contract once it broke the bullish support line. This level right here was the point at which it said the bullish support line, which was right here, was broken at this level. That said okay to go short the Swiss franc. But the risk reward was too great for us at that level. We couldn't take the heat to the stop point. The stop point is if I'm short a contract, when do you stop? On every buy signal. The buy signal would not have taken place until this level. So what we did is we entered an order back up in this level and said, okay, we're willing to go short this level because it gets us close to our stop point. Well, we were lucky enough that the future went up there. We went short at this level, but it continued on up to our stop point. It stopped us right out at this square, but notice it was still below the bearish resistance line. It had come up and hit the trend line. Now what do you do when a future comes up and hits the trend line but doesn't go through? Move it out one box, correct? So we moved it out one box. That kept us below the bearish resistance line. And if you are still below the bearish resistance line, you went short, you were stopped out, the future still below the bearish resistance line, what do? What do? Go short on the next sell signal. Next sell signal took place right here, and we caught a tremendous trend. But the only reason that we caught this Swiss franc trend and it caved in and gave us a phenomenal trade, and these are the kind of things that can make your year, is that we probed the trade. We went in right here, got whacked real quick, and how many of you would have gone to the sidelines and said, to hell with the Swiss franc, I'm going back to bean oil? A lot of people. You probably wouldn't have gone back into that same one. It's like getting knocked out and going back into and fighting the same fighter. So in this case, because we were willing to probe the trade, we caught the next sell signal and this decline. So probing the trade is extremely important. When you're trading these things, you have got to continue to try the trend. Here's a case in point again. We're in the March contract. We don't come into March until here. This is mostly we're still trading December in this area. March contract, when we switch over to March, we get our first buy signal right here. Now, once you're trading above the bullish support line, you go long on a buy signal, where's your stop? Will be the first sell signal that develops, period. Still enough to see. If I were to go long right here, simply reverse this down and count until you get a point in which a column of O's is exceeded by another column. So this would be 1, 2, 3, 4, 5, right there. So my stop point initially would have been that level. Well, that doesn't happen. It comes down to this level, holds, reverses back up, but then eventually stops us out right here. We got stopped out at 98.5. The contract, the bond, was still above the bullish support line. Therefore, what do you do next? Go back in on the next buy signal, correct? Because you have to continue probing. You can't just put one trade on and walk away from it. We're going to trade this thing. The next thing that happens is we get a buy signal right at this level. When we get our buy signal, where do we stop? On the first sell signal that develops. So if I buy my contract right here, I simply have to count down to a point at which a column of O's will exceed a previous column of O's, and there's my stop point. That doesn't happen. The future pulls back, gives you a heck of a scare, comes right back to the trend line, you're biting your fingernails at this point, reverses right back up and gives another buy signal. It continues on moving up in the buy signals until you finally get your first sell signal that stops you out. That's the kind of thing that can happen, is what happens here. Our first loss was $1,875, was that 18, yeah, 1187. It's hard to see with these lights. And our second gain was 2625. So we had to take a loss to eventually get the good run. So the net result is we had a very profitable trade, but it took us a couple of times to probe to finally get to it. So you have to probe the trade. Soybeans, November contract. This shows you how we stop out on 18 boxes up or down. Again, we come in, we finally break the bearish resistance line at this level. The bearish resistance line here is broken at this level. We want to go on the next buy signal. Why did we have to wait for that level to begin trading? To break the trend line, precisely. It would have been great to be in it down here, but what's the first rule? What's the first rule? Don't go against the trend. If the trend here is down, even though you have a beautiful chart pattern down here, forget it. Once it breaks the trend, then we can go long. Here we go long in this contract in the November. It comes down here and almost gives us a stop. Here's our stop point right there on the triple bottom. It comes down and forms three bottoms, but doesn't give us the last one. Gets you really nervous. The future then reverses and moves up. Moves up more than 18 boxes. We stop out on the first three box reversal. This ended up being 4 boxes, and we stop out of the position there. So in many cases, when you have a condition in which you have that type of a run, straight up with 18 boxes, we elect to sell on the first 3 box reversal. That deviates from the program a little bit because you are not supposed to sell until you get a sell signal. But we like to throw that in because in many cases when you get an 18 box up or down move with no retracement whatsoever, you've pretty much got most of the run. You can always go right back in on the next buy signal and you'll have a very logical stop. But again, the reason that we went long here, above the bullish support line. Even though you were stopped out at this level here, why couldn't you go short? Above the bullish support line, correct? So as long as you're above the bullish support line, you cannot go against the trend. You must stay long. The Canadian dollar. Another example of probing for the trade. In probing for the trade, notice this beautiful catapult formation that takes place right here. This is as textbook as it gets. You have a nice triple top buy signal that takes place here. The double top confirms it at the catapult, and we get long the contract right there. Since you're unable to sell until you get a sell signal, we lose a good trade. We could have gotten this thing, traded it right up to here and gotten out, but we didn't know where the top was. So we sell on the first sell signal. The future then comes back, gives the first sell signal, stops us out. So we don't make too much money, $220. We were going back in on the next buy signal that takes place. The trend line, this effectively broke the trend line, but the buy signal here puts the bullish support line back in effect. We go long on this buy signal, get stopped out for a loss. In this trade, we lose $300. Second trade, we lose $300. We go back in on the next buy signal, but instead of taking the buy signal in this breakout, we put an order in to buy on the pullback. Why? Because it got us close to our stop point. Still, the trend line is trading above the trend line. We buy on this level. We can't stop out until the next stop, which is at 74.18. So our next gain was $7. So we made 200, lost 300, made 700. The whole idea is we continued to work the commodity. We continued to work it. It wasn't a matter of going in here like Las Vegas and rolling the dice on one trade and saying, okay, well, heck, we lost on the second trade, let's get out. As long as the trend line continued to suggest that you play it long, we continued playing it long. Once that trend line was broken right here, what does that mean? You can go short, but you cannot go short until that trend line is broken. So once this trend line was broken in here, this tells you you can go short, so you go up at that point when this bullish support line is broken, and you draw what? Your bearish resistance line. And how do we do this? We simply come up to the top and we connect the boxes down. And as long as the future stays below the bearish resistance line, how do you trade? Short. You never go against the trend. Lumber chart, in adjusting the box sizes. Sometimes the future will get too wild and erratic. What it's saying is when the future is as wild as this lumber chart is, it's saying the volatility is too high for the chart, or too high for the future, or for the box size. So what we will do in a case like this is we'll typically increase it from 10 cents, where you have a wild chart like this. We can increase the box size to a 20-cent chart from 10 cents, and you see you get a much more logical picture. What you give up, though, your signals, when you increase the box size, it has a tendency to slow the chart down. It gives you a better picture, but your stop points are much more painful. You could increase this box size to $1 a chart, and you would probably have the most beautiful chart, but it would be so long-term, your stop points would just be killers. So you try to find a happy medium. So you can increase your box size when the volatility gets much too high. The Japanese yen is so wild, the box size has to get so high that it's just virtually not even tradable. One more thing here. Let's go look at a US dollar chart, adjusting the box. Here is, this shows a very volatile dollar. We adjust the box size now. And notice how box size is now 20 per box rather than 10 per box. And notice how the chart becomes much more logical and much more organized. But again, the stops become a little more painful. Now, two more pictures here I wanted to show you, and we were talking about the long-term charts here. Here's your dollar spot. And I thought I had a bond spot. I don't. I have the December bond just to show you what it looks like. But the dollar spot chart, you can see how this is much more long-term, 1994 and 1995, and it gives you an idea of what the dollar is now. So looking at this chart right now, if you were looking at a long-term picture of the dollar, would you be inclined to trade this long or trade it short? Long. Why would you trade it long? It's above the bullish support line. If you go long on a buy signal, you'll stop on what? The first sell signal develops. If the first sell signal stops you out of a trade, and you're still above the bullish support line, what will you do? You'll go back in on the next buy signal. Conversely, if you are short a contract and below the bearish resistance line, you will stop on what? The first buy signal that develops. If that buy signal develops and still keeps the contract below the bearish resistance line, you will continue to do what? Probe the trade and continue to go short. You will stay short until you receive a buy signal. When you move trend lines, a trend line, a bearish resistance line, when the future is below the bearish resistance line, at what point can you lower that trend line? Future is declining, and this is one of the hardest things to think about. Picture in your mind, how can that trend stop? If the future is bearish, how can the trend stop? Must give a buy signal, correct? So once it gives a buy signal, okay, it stops it. Now when it's followed by another sell signal, it effectively says, hey, that last buy signal was the new top. That was the top. When it went up to a certain level and couldn't go any further, and then it gave another buy signal, hey, that was the new top. So you can move the trend line down. Once again, on a bearish resistance line. How can you move the bearish resistance line down? Futures below the bearish resistance line. Future must do what? Give a buy signal, followed by a sell signal. A bullish support line. How can you raise that bullish support line? Future is above the bullish support line. You get a sell signal, followed by a buy signal. That sell signal effectively stops you out of your trade, stops the uptrend. Once you get a new buy signal, it's saying, hey, this is as far as that new contract was able to go down. That's your new support level. Couldn't go any lower. So once again, let's go back to the bearish resistance line. When you have a bearish resistance line, you can lower it by doing what? When the future does? Gives a buy followed by a sell, precisely. On a bullish support line, you can raise it by when the future sell followed by a buy, precisely. That's the main characteristics of the whole thing. We will only trade the trend. You will not, when you're above the bullish support line, you can only go long. If you're below the bearish resistance line, you can only go short. We can move the trend lines just as we said. Move the trend lines whenever possible. If you are long a contract, you will stop on every sell signal. If you are short a contract, you will stop on every buy signal. You'll continue to probe the trades. You must probe the trade to finally catch a trend. Very important. Let's look at the T-bond December contract, the one we trade now, and there's what the picture looks like. How do you trade this contract now? Long the contract, exactly. Even though it looks like you've got a tremendous amount of space down to the bullish support line, you only trade the contract long. Why? It's above the trend line. So we have the rules and regulations with the point and figure chart. It's very difficult in an hour and a half to go through a total course on this. We could spend a whole weekend on it. But in this hour and a half, I think we've been able to outline exactly how you would go about trading futures. And you can't deviate from this. Like I mentioned in the beginning, you've got to get religion sometime. And if you'll follow this methodology by moving the trend lines whenever possible, probe for the trade, only trade the trend, and the beauty of the point and figure chart is when you get to the point where they say let the trend be your friend, let your losses run, the way you let your losses run is you stay with the position until it gives you a sell signal. If you buy a bond at 100 and it doesn't give you a sell signal until 120, wow, you made your year. But what the point and figure chart does is give you strength in your conviction to stay with the trade until these things happen. By the same token, part of the key to success in futures is to cut your losses short. By cutting your losses short, by stopping out on every sell signal or every buy signal that takes place, if you initiate a trade and immediately get stopped out, you will be stopped out by your predetermined amount that you're willing to risk. So it forces you to keep your losses short. Last year in our commodity trading account, we were up 38% net of commissions, and I would say probably over 50% of the trades went wrong easily. Maybe 60% of the trades went wrong. We did not have the right trade, but we were able to manage our money by keeping our losses short, and by letting our profits run, and probing, we were able to catch the trades like the Swiss franc and some other trades that really that make your year. So you can have a lot of small-term losses, but once you let a few of these trends run, you can really make it. Now, we have 5 minutes left. Let me go ahead and open it now to some questions that you might have. And I know this is a lot to cover in an hour and a half. At least I think everyone's got the idea now, you know, once we've gone through it. Yes? This one?
Well, it could have been. Say that the support line was forward. Say that one was far higher up. So that the second there's the far down here, the far down. The price will go down there very far to your left of your point, to the left of this area.
Uh-huh.
Yeah. Where could you go short there if you had the support line high above?
That came up here?
Or well,
Let's say the support line came up to this level?
right.
Okay. The only way that you would have gone short is if the support line came up to this level in the chart. It affected, because you have a sell signal here, and it breaks the chart. Let's go ahead and draw it on there. The question was, in other words, we're kind of making a movie here. If this support line was much higher, in this case, let's just draw a line up to this level, at what point would you go short? Well, since this is on a sell signal right here, it breaks the trend line at this level, right at this level, you would go short on the next sell signal. Now, because you're already on a sell signal, you would probably initiate a point on some kind of a reversal up in this level where you would go short. You're already on that sell signal, so this effectively says, okay, you're on a sell signal and the trend line was broken, okay to go short. But with the future having come down this far, you definitely want to get it up closer to your stop.
But you're not allowed to go in.
No, you could not go in. Mainly because of your stop. If you went into the future right here where it broke, and you went short, where do you cover? On your first buy signal, correct? If you're staying with the program, your first buy signal is all the way up here. Can you take that much heat in a T-bond? Probably not. You're talking about thousands of dollars of risk in one contract. So that tells you right there you couldn't have done that. So when you're looking at risk reward and I want to go short, you say how much can I risk? If I only risk $500, then you have to be willing to sell short up in this level here. You see what I mean? Yes. Any more questions?
You mentioned in your book that you devote only one chapter to futures and the rest equities.
That's right.
Aren't these concepts the same for both?
No, they're different. Totally different. 100% different. The question is, aren't these concepts the same for for stock trading as futures trading? No. Futures trading is a large part of it is managing money. And with stock trading, one of the first things you learn with stock trading is 70% of the risk in a stock is the sector in the market. We spend 80% of our time evaluating the stock when that's not where the risk is. So when you look at my book and you read the book, you'll find the major chapter that was written there was on sector rotation. If you can buy a stock in the right sector at the right time, you basically can make all the mistakes in the world. So no, you don't trade stocks like this at all. Different philosophy.
So we are out of the T-bonds, right?
Yes. At this point, you are out of T-bonds right now, and we'll wait to see what develops. If this develops, let's say this moves back up in a column of X's, back down in O's, and then back up and breaks out at this level, we'll go long the contract. So we can take the next buy signal. Yes?
Where did that support line come from? It just came out of the ground.
Out of here?
Yep.
Oh, that's just going back to where the future was trading way back here. The whole thing wouldn't even fit on one chart. So we just took it at... That's where the actual support line was drawn. If we had a chart that went over here. Yes?
Is there any software that does this?
Yes. Is there any software that does this? TechnoFilter Plus out of Raleigh, North Carolina, that runs on Dow Jones Market Analyzer Plus, DJ Map, does this. I think Metastock has it in their 1994 version. They've taken it out of the 1995. Many of them have that. In fact, you'll find point and figures right in the room here on some of these systems. But it's important that you stick to be successful. You can't use the point and figure chart just as a cursory type thing. So, well, I'll just look at the chart every now and then. To be successful in trading, you've got to get religion, as I mentioned before. And if you follow these principles, you're going to be successful. There's no question in my mind. But you can't deviate from it. You can't go long a contract and say, well, gee, I'm up a point, and I need to cover my losses on the last trade. I'll go ahead and take this profit. You can't do that. You've got to stick with the rules and regulations.
Hi, my name is Adam Hewis, and by now you've probably heard a lot about our giant footprint technology and just how important it is in the marketplace and how it can help you make money. But I want to show you a good example using children's art of just how powerful our giant footprint technology is. Everybody that comes to our offices, we ask them to take this test, and that's the fish test. Now you're going to ask yourself, what do fish tests have to do with giant footprints? Well, I'm going to show you right now. Let's take a look. I want to ask you,